All right. Welcome back, everyone, to the Crypto and Coffee podcast. This is episode 8, and my name is Julian Morris. I am the founder of Etc., and I'm joined today by Cordell Tanny, the CEO of Vault 42, as well as David Blackstone, the CEO of Orchestra Labs. And in today, we have, a bit of like a broad topic, but first, we're going to start talking about RWAs and a little bit on the regulatory side of it. So just to start off, for anyone that doesn't know, RWA stands for real world asset. So this is basically, tokenizing a real world asset, like let's say, real estate, artwork, whatever it may be, and you're putting it on the blockchain. So, Cordell, David, if you guys would like to add to that, give you guys 2 cents, probably broaden the definition a little bit more, that'd be fine.
Well, definition is, can we tokenize or make all assets digital? I think that's really what it comes down to. And, the benefits, I think that's something that we'd have to discuss is what are the benefits for RWA? Do they confer real ownership, like owning the real asset would? That's a huge argument. And if we do, like, why are we doing it? What kind of a world does that open up? Those would be the main three things that I would say matter most to me when I consider, of course, aside from regulatory, but that's what I would say would likely need to be discussed in terms of the RWA is, okay, great. If we tokenize them, why are we doing it? What are the benefits to it? And then what does that really give you ownership?
Well, just to start off, I think that it does give fractional ownership. Like, so say for instance, we have like a company that owns a piece of real estate, right? If you're tokenizing that, you can give other people a fraction of the ownership by when they invest into the property. Like, say for instance, you have 1 million NFTs, or you fractionize. No, you're not fractionize. You tokenize like a piece of real estate into, like, let's say, small shares. Everyone that invests into that can get a piece of that, as well as, like, say for instance, that real estate property is generating cash flow. Everyone who owns a piece of that share can actually get cash flow. But also, if I think you talk about like what are the pros and cons, I think this, depending on what the real world asset is, it is mostly like a compliance issue. Like, say for instance, real estate, you gotta make sure like your paperwork is in order. This is like a very pro compliance thing.
Okay. Well, let's take the real estate. If we're gonna, let's dive into it right away. Let's first, like, let's say we're taking real estate. Now, first, exactly what does tokenization even mean? Like, how do you tokenize a piece of property? How do you tokenize real estate? So normally, I think when we're talking about tokenizing real estate, we're not actually tokenizing the house. Okay, and that's very important, or the building. What we're actually trying to do is we're taking whoever owns the house or the legal entity that owns the house, and you're tokenizing that. So if you think about what we do with real estate mostly nowadays, let's say like a real estate investment trust, which is essentially companies set up. You buy a series of properties, cash flows come in, and those cash flows are paid out to the shareholders or the unit holders of the REIT, or that's what we call it for short. So the tokenization process is designed to, let's say, replicate the creation of a REIT. So in this case, instead of just pooling all of your investments together into a legal structure, what we're talking about is taking that legal structure and then tokenizing it. And then people can buy, fractional shares and, yes, get ownership and that. So that's really the process. So then, how does that work? Are there differences in terms of you owning a REIT or owning the property? What are the risks? I think that's really what it comes down to. And then, of course, the regulatory framework and how does it represent a systematic risk? And I think that's ultimately what it comes down to. If you start tokenizing all these things and the thing fails, what happens? Does the entire system collapse? So, those are the kind of things you'd want to consider when looking at it as an RWA, because ultimately, if you're the investor, why would I buy the token instead of the REIT? Like, what's in it for me? Why would I take on the extra risks of owning the token compared to, buying into the REIT? That's the way I would look at it.
Yeah, but just like this is just my opinion, right? You can say it's a low barrier to entry for certain people. Instead of like buying the entire property, you can just buy fractional pieces of it, and then over time, depending on if the value of the property goes up, the value of that fractional share also goes up, right? So in the case of someone who is just buying the NFT or like the fractional share of the property, you're taking less risk, or you can use less capital than the legal entity that owns the actual property itself, right? So that is how I personally see it from an investment standpoint, like a small investor standpoint.
Well, yeah, that's one thing. I think it's just from it's supposed to increase access, let's say, to smaller investors or to get other, to get other people into it. But I mean, look, nothing is stopping you from putting $500 into buying $500 of a REIT, right? Open a discount brokerage. Nothing's stopping you from doing that. So then why would you go the tokenization route? Why would you prefer the token than to buying the REIT?
I think personally it gives back, a little bit to the people itself on the blockchain. And again, I said it is a very low barrier to entry depending on the price or like the floor price that it's being sold at.
Okay. So, I mean, I think the other way to look at it, I mean, because that's a good point. It's just that when we start looking at, like, it's like, what kind of properties are you going to wind up being like to tokenizing, right? Because ultimately, buying a REIT, or let's say just being an individual and buying a REIT, you're actually buying a stock. That's what it is, because this thing's still trading on a stock exchange. You're buying a stock, which means you're buying beta, which means it doesn't matter how well those properties are doing. If a crash happens in the market, odds are your investment's going to suffer too, even though there's nothing wrong with your investment. Tokenizing will more likely be used to help, let's call it, by solving an illiquidity issue that you have with real estate. So if one of the biggest problems with real estate, or buying physical real estate, if you want to go out there and be a real estate investor, okay, buying a REIT is one thing, but again, you're buying beta. But if you're buying the token now, or you're buying a private asset now, how do you get out? And that's always a big issue when dealing with private assets and these alternative investments, is liquidity. I can get in, but you can't get out. So you have what's called an illiquidity premium. So the tokenization process should help, in theory, with the liquidity, because now you can buy pieces of property and all this and not have a problem of getting in and out. So, whereas buying into a real estate fund, that could lock you in for anywhere to 3 to 5 years. If you were to buy into a private real estate fund, you're locked. You've got set redemption periods. You can probably only get out 4 times a year, usually quarterly. And once you're in, you're usually at least 3 to 5 years before they'd even let you get out. So tokenization is supposed to solve that problem. So that's one advantage I see in terms of the tokenization. And that's not just for real estate. It's for very many assets, is it should help with liquidity.
True, and I completely agree. David, do you have any opinions from the blockchain standpoint, seeing as how you operate on a stablecoin based blockchain?
Yeah, I don't see too many benefits institutionally for blockchain over stocks, because you have this set place here. It has a long track record. It's got a lot of backing, and you've got a long history of other companies that have gone through whatever you're planning to go through. So there's a roadmap for exactly what you need to do for anything you need to do. Given how in the last year and the previous years before that, how we've seen, and how most people should recognize at this point that the people at the helm don't know what they're doing, that is a great benefit. Being able to just check a roadmap and see what you're supposed to do is a great benefit, especially if you're delegating it to someone else who also doesn't know what they're doing, because then they can check the roadmap. So you have that, and that's a great benefit to the people that do have the money. For the people that have the money as well, that looking at this, as we've seen from this year, it is a lower regulatory environment, which means that things can move forward. Now, that means that things can move forward in two ways. One, in ways that can benefit the user, the masses. The ultimate end goal here is to make money, and the largest group of people, the place where you're going to make money, the place where all these where the rich generally get more and more money over time, is from the mass of people, like the people doing all the work. The ones who grow the food and the ones who move it around and all that stuff. Like all of that stuff is where wealth comes from. So not because of the work itself, but because things, like literally you make the things and the things are the wealth. So with that, you have money that will come from those people. Now, if those people can't access the stock market because the stock market is too expensive, then they have to go to another place where they have more access. And that place that has more access is the blockchain, because you can separate things not just into the millions of units, which may be manipulated price, which may be greatly inflated on price. For example, a lot of people aren't going to like me on this. Tesla, they've year after year. Here's my take on it. Year after year, they've made promises. They've not followed through on those promises, and they're losing market share on cars. They're selling less cars every year. Every year, Elon Musk says, "Well, by next year, we're going to have AI. We're going to have robots. We're going to put a man on Mars. We're going to have self-driving." Meanwhile, Waymo has self-driving. China has robots. We're no closer to either of those other things, and we're now going to be battling inflation. Well, we've been battling inflation. We've been losing on that, and we're going to be encountering other financial crises. So I think Tesla is inflated. I'm going to use them as the example of an inflated stock. And if you could buy into another company, then you could do that at a cheaper rate via the blockchain. And then you also have 24/7 access. You don't have to try to trading while you're at work. And given that you're probably going to be at work if you're the common man, because you need to work in order to pay for food, unlike someone that's operating off of daddy's money, well, you can do that. Because with blockchain, you can trade on weekends. You can trade in the morning. You can trade in the evening. You don't have to wait on the 9 to 5 that the stock market runs in, that the bank runs in, that every financial system runs in, which is when you're at work. You don't have to take time off of work and have eyes drawn to yourself in order to try to get into assets. So I think that that's the benefit, like easy access, 24/7 access, not necessarily anything else, because low regulatory environment, that brings some scams. You can move things forward more easily, which is why Uber took off, which is why Netflix took off. Well, not Netflix, but which is why many tech companies took off, because they said that this thing is not that thing that's regulated, because look, it got tech under it now. So then they were able to move in a lower regulatory environment because of that. That's where crypto was. Maybe not is, but was. Maybe still is to a point, but like that's where it was. And so there's great benefit to that. You're going to get more scams, yes, but you're also going to get things moving forward more easily. You've got the great benefit of 24/7 access. You've got the lower cost to get in. You've got lower regulatory pressure. You've got to be careful with it, yes, but you've got lower regulatory pressure. And yeah, institutionalists like that as well. Like we've seen from the start of the year, like many scams have been run by by very greatly rich people, by really rich people on that. And yeah, they really like that lower regulation because they can just take money from you anytime they want. But for the people trying to build something, it also makes it easier for them because they don't have to hire $100,000 worth of lawyers just to get an app off the ground. So like there are those benefits, like those main three. Other than that, I think that like big companies and everyone are probably going to be better off going to stocks.
Yeah, I mean that I agree with. I mean for a number of reasons. I just find it also interesting. I don't want to go too much on a tangent here, because when you bring up the 24/7, right? Because NASDAQ will be introducing 24/7 stock trading in the second quarter, likely, I don't know, let's call it the second half of next year. And I've got very mixed feelings about that. I mean, I don't really think how much of a difference it'll make, because it's not as if, you're going to have banks and everybody going to have employing people working on their trading desks 24/7. So, that's a major fundamental shift of how these companies operate in terms of their human resources and the systems. And, given the fact that most of the market's dominated by institutions and pension funds, most pension funds do not need to be trading at 2 a.m. It's going to be a retail thing. And, maybe the high frequency traders are going to love it or they're going to hate it because it will increase their market making kind of responsibilities. And imagine like you're an exchange traded fund or, you're a market maker. What, you now have to be around 24/7, or at least, sorry, it's 24/5, I think, to make sure that the ETF market is running smoothly. I mean, I'm very curious about how the 24/7 for stocks is going to work. Personally, as a quant, I'm really against it because so many of my algorithms are based on having a defined open and close. And if you take away my defined open and close, it's like all my strategies might not work anymore. And I'm just really curious. It's throwing a huge wrench into a quantitative finance engine. So, I don't know to what respect if tokenization takes off at the same time and you still get, you're getting fixed income and equities being converted to tokens. Is that going to start really messing with the stock market frequencies and volume? How much volume did it take away? It could break almost every quantitative strategy out there. And that's kind of making me a little bit nervous. But no, I get it. I mean, a lot of it is just so, because if you have the ability to start doing your trades, once you get home from work, you have time to do your research, do your trades, then you don't really require a financial advisor anymore because part of the advantage is you didn't have time. Now you will. We'll see. I still think most people will still end up using an intermediary for most of their, I would call it maybe not, I don't want to call it gambling, but, most people hire a financial advisor for a reason. It's because they don't have the expertise to do it. It's not just about the time. So, David, I want to come back to something else that you said there. So let's, in terms of like, because we were using the example of real estate there, for example. And yeah, I think the institutional market absolutely is going to be sticking to whatever format they're currently using, private funds and all that. It's really much more of a retail thing at first is going to be the tokenization. So for real estate, I think we can agree there's lots of benefits, right? Because if you wanted to go out there and buy a share of private real estate, okay, you'd have to get into a fund, which most likely you cannot because it's high minimums, high lockup periods, and it's for accredited investors. Accredited investors meaning they have to satisfy, you're essentially rich. It's essentially what it is. It's a high net worth investor. Tokenization, though, right now, under the regulatory framework in the US, still requires you to be, unless I'm wrong, an accredited investor. So that would be a major change that has to happen, right? I mean, right now, the regulatory environment isn't there for the retail investor. It's there for the rich. So
well, yeah, because once regulation came in, then like everyone's like, oh yeah, regulation comes in, and then we're all going to make money because it's all going to make things. It's going to bring in the institutions. Well, none of those people knew what regulations were, did they? Because if you looked at regulations for any other industry or even just finance before that, what regulation does is it comes in and it stops competition. Yes, it can stop the scams. Usually not, because you can if you have enough money, you can usually pay people or free up enough time through paying people that you can figure out how to run scams. Like you just find the loopholes, and there are always going to be loopholes because these are rich people making rules for rich people. They don't want to like exclude themselves. And like they don't care about you, and they've shown that. So now here's the thing with that you get regulation and you get barriers, and every single time you get barriers, yeah, maybe it'll make the companies feel better, maybe it'll make Coca-Cola come onto the chain, but what it's more likely to do is the same thing that it's done every single other time regulations have been introduced. And what that is a company or multiple companies, and this is why Circle won. This is those companies saying, I don't want to compete anymore. I think I've gotten far enough that I shouldn't have to compete anymore. So, lawman, here's $20 million. Write a bill that says that I don't have to compete and other people have to do what I did. So, like Circle, for example, they come in, Tether, they grow, they have a business model that allows them to make more money than Circle. Circle doesn't like that. Circle goes over to the regulators and says, here's some money, enjoy all the money. Now make everyone act the way, make everyone have a business that operates the way that I did. So now Tether has to put up another stable coin that operates the way that Circle's does, which means that Circle won because they convinced regulators to make regulations that say that everyone has to act like Circle, completely neglecting the fact that Circle fell when Silicon Valley Bank fell, because Circle didn't create a system that was robust enough to actually handle that kind of situation. So it's not about safety necessarily. It's about making sure that others don't have to compete against you. Let's look at the regulation. Let's look at the regulation for accredited investment. If you're an accredited investor, what most people look at that and think is, oh, well, that means that you're a good investor. Like, you know what you're doing. But when you look at the rules, that just means that you have $1 million, or that you make more than $100,000 a year, which at the time that it was introduced was basically like you're rich. It's not you know what you're doing, it's you're rich. If you've got daddy's money, congratulations, you're an accredited investor. You may be like 5 years old, but you're an accredited investor. So you bring in regulation, you bring in barriers, and what those barriers end up doing is blocking the poor people. Do poor people necessarily have too low of an IQ to be able to trade, to be able to run a business? No. But the regulations will say that they are. The regulations will say, you don't have enough money, that means that you're a failure, so you can't do this. Yeah. So like every single time the regulations come in, that's what happens. So yeah, regulations, like, they can be good. They can bring in institutions. There are certain regulations that are beneficial to the end user. Like, for example, blocking use of information in certain countries. Like, you're not allowed to collect user information without that user's knowledge and consent in certain countries. That's good regulation that protects the user, right? But a lot of these other regulations, like the ones that I mentioned, are entirely designed to stop you from getting into the market. So like, yeah, like there are benefits and all that, but I don't see much of a benefit otherwise.
Much of a benefit to
the end user,
Okay.
to the masses of people, the ones that actually move things, not the people who make the decisions. Like, yeah, a lot of people think that and yeah, there is a great benefit to the rich people making jobs and all of that stuff, and yeah, there is a great benefit there. But overall, from what we've seen within recent years, like, generally they just say they have no idea what they're doing. So if you have a bunch of people at the helm, so a bunch of people with money that have no idea what they're doing, and all they're doing is getting socialism for the rich, you're not moving things forward. You're just putting in mud, so that way people's tires spin and they can't move forward. So like, it's not like you have all these market pressures, and for all these different reasons to try to bring in various companies and try to get them onto the market. But I don't see much of a benefit in doing so, because yeah, like maybe that'll bring in, like, for example, Coca-Cola or Pepsi, and bring them onto the chain. Maybe that'll bring in some more money onto the chain, but will that benefit you as the end user in the end? I don't really think so. Like, as you mentioned, that one regulation, accredited investment, like that is like that just blocks people from tokenization at this point.
Oh, yeah,
like, they were able to do it before, they can't do it now. They were able to. I think that that blocked you from making tokenization for various things, such as real world assets or putting up a business and getting that funded via the blockchain. That didn't block meme coins, which is a scam, which ran multiple times via our very own president. But that did block Joe Hardware from making a hardware company and getting it funded, so that way he could put up a competitor to Home Depot.
Yeah. Okay. That's that's a problem. Sorry, Jay, we're gonna say something.
Yeah, I think based on what David said, it's completely true. But with like tokenization and like the whole concept of like crypto and decentralization, I think RWAs can bring like a whole let's say sector to like governance, right? So people can also vote on what like they want to do with the RWA, depending on what it is, right? So that is just like a kind of 2 cents from me.
Well, can you give an example?
Okay, let's say for instance, let's go back to like the real estate example that I proposed, a while back earlier in the episode. So say for instance, you have people buying up, fractional shares of the property, right? Some people may choose like something very, let's say frivolous as like, paint the property red. You can expand the property a little bit more, put in more units in the apartment complex, stuff like that. People can vote on, small stuff like that.
Okay. No, I mean, I get it. I mean, that is the appeal. I mean, that's really what it is, right? Is you're trying to get, it's almost, I don't want to call it crowdsourcing or crowdfunding to a certain degree, but it is really what you're doing. It's just, allowing people to fund a project while bypassing prospectus, KYC, and doing all of that. And I think that's one of the biggest problems that the regulators have with it, is by so doing, you're bypassing all of the safeguards that were there to put, to protect people that, well, I guess are just so dumb that they need protection, right? So much for caveat emptor or anything like that. So, but like when we talk about the tokenization for real estate, for art, I mean, easily we can see the benefit, because like you're trying to open up markets which have been reserved for the rich, reserved for the pension funds and the institutions, and making them more efficient, hopefully more efficient, more liquidity and all that. But, when we start, because what I'm trying to do is really tokenize hedge funds. One of the things that I would love to get done is tokenize a lot of my strategies, put them on platforms, and then anybody can get access to, let's say, hedge fund style trading strategies through a token, which is great. And there are a couple of sites up for that, So, I mean, I definitely love the prospect for tokenizing investment funds. And, that opens up an entire market for asset managers, or for people that want to offer strategies to people but don't want to become a custodian. Running a hedge fund is not easy. All right, like the legal stuff needed to set up a hedge fund, and the regulatory and your accounting is brutal. It's not for everyone. But the tokenization of such funds could really change the whole nature of it, which is probably what would scare the crap out of regulators, because then you're just bypassing the entire industry into, some kind of unregulated Wild West vehicle. And hey, we've seen how stuff like this, you get Bernie Madoffs every second day. This is just opening up an entire world for fraud and for potential crime. So, I mean, a certain degree of regulation is necessary. So, but no, my point is that I get it. Like the tokenization could do so much to open up a world of investments to people that normally would not have access to it, while at the same time, the people creating the tokens are now being able to access a whole world of capital, which normally they would not have had access for. Now, but if we take the example, though, of stocks. Now, imagine trying to tokenize equity. And this is the one I'm still trying to figure out. Why would we want to do that? And the reason why I say that, if I own shares of JP Morgan, I own part of the business. I technically I own a portion of that company. I'm entitled to a portion of its earnings. I get dividends. If I own the token, I don't get any of those rights. I won't have voting rights. I won't get the dividend unless they found a way to get these mechanisms into the token. So I don't know what you guys think about the tokenization process for equity, or why would we want this? And I don't know if 24/7 trading is enough of a reason.
So for me, I think like when you tokenize a stock itself, what you just said, you do lose some of the power in terms of like the rights you get. But if you're looking at it from an investment standpoint, whenever that stock goes up, the tokenized version of that stock goes up, because it is pegged to that stock itself, right? So that is one thing, So say for instance, you're outside of the US and you can't necessarily invest in, the US market or the stock exchange, right? This is one way you can look at it. But if you're a US citizen, you can go on Robinhood, You can go on like any other like stock exchange or brokerage or whatever, and you know you can like invest and you can have like the voting rights or whatever to do with it. But like the tokenization does open like let's say the barrier to entry for like other countries, because that way like someone in Japan can invest in the US stock market or invest in like the European stock market or whatever the case may be.
Yeah. No, I hear you. No, I absolutely hear you. I mean, I'm still trying to figure out, what that means or like why that's an advantage. Like, I that's what I still don't figure out. I mean, I just don't understand like why I would want to tokenize an equity. I mean, personally, from someone who creates these things called vaults, and I think that's actually a worthy discussion too, is the vaults and that role in the tokenization of RWAs. Having access to more, securities, especially stocks, trading as tokens, which I could then easily trade via API in an infrastructure. No, that opens up a huge world of algorithmic trading strategies that I could then run using tokens, and quite frankly bypass a lot of the the big brother framework designed to watch out, to protect people. Not that I'm saying I'm doing anything wrong. It's just that, like you said, it just adds red tape, it adds time, it slows things down, and it's costly. But that's me. I mean, that's just a little bit of a selfish thing. Is like, if you give me RWAs and equities and stuff like that inside tokens, and then I can start trading these in my vaults, yeah, I become very, very, I'd become a serious threat against the hedge funds in any event. So you guys are familiar with the vaults? Have you ever looked at something called like D-Hedge or Enzyme or Plume? Are you familiar with the vault structure?
Not those.
Not those? Which
Yeah,
ones
not
are you
with
familiar
those.
with? I'm kind of curious.
Well, with various apps, I've seen them introduce things that they've called vaults. They might be a bit different. So, why don't you explain what those are? And I'm probably thinking of something else, because with when these various apps introduce something that they call vaults, they're probably not the same thing.
No, they're probably not the same thing. I'm not going to claim to be an absolute, like I know everything about what every other company out there is doing, what they call a vault. But in this case, if you're looking at sites like D-Hedge, Enzyme, Plume, these vaults are essentially a token, right? So anyone could go to these sites and create their vault, and then anyone could then, using, tying their wallet to the vault, could then exchange, let's say, USDC or Bitcoin. In this case, normally be wrapped Bitcoin or wrapped Ethereum, because likely you're not trading on Bitcoin. You're probably going to be on an Ethereum layer or, something else, Polygon, Optimism. So you're able to trade units of one current cryptocurrency and acquire units of the vault. So it's essentially like a tokenization process. Inside this vault, for example, I've got, let's say, one of my strategies will buy and sell Bitcoin according to various signals. So anybody who wants access to my strategy could, in theory, go to the vault, right? Exchange units of USDC, they get units of my vault, and these units would show up in your wallet. So when you look at your wallet and you would see all of the things that you have under that wallet address, you would see how many units of the vault that you own. So the vaults are essentially tokens, right? They function as tokens. So I have essentially tokenized a trading strategy or a hedge fund that anyone could have access to. No KYC, although they're, this is why it's not legal in the US, because it is for accredited investors. It's because you have to go through the KYC process in the US, even for the vaults. So the vaults have just provided this whole infrastructure that allows, I hate to use the jargon, but it's just completely democratized a tokenized, call it RWA, but in this case, the RWA is a trading strategy. So, however, my trading strategies are, of course, limited to the assets or the tokens, the coins that I have access to through, let's say, D-Hedge or Enzyme. So if I'm creating my vault on Base, well, okay, I need to have whatever tokens trade on, I can have access through Base. So I can use a wrapped Ethereum. I could use CB, I could use Coinbase's, Bitcoin. I have access to all that. Whatever trades on Base, I have access to. but I don't have access to equities. I don't have access, there is gold, right? I think, but gold I'd have to do on Polygon, I think. So you're limited. You're very limited to what's actually traded on the protocols that you're on and the platform. So whether it's Base, Optimism, Polygon, you guys know what these are, and you know that not everything's available on them. So you're limited to that. So it's a very early stage. So the way I look at these vaults, it's really a tokenization process, and Plume is more of the institutional level site. So this is where you'd see BlackRock building, but you need 100 million of committed TVL before they'd even look at you. So it's a whole new world. That's the way I look at it, it's part and parcel of the whole tokenization and opening up this new world to people that otherwise would never have access to it. And there's a lot of advantages to it. Like you said, 24/7, anyone could get in. You can get in and out in a matter of seconds, minutes. There's no lockup phases. So I find it incredible, but it is the Wild West. And, the US is still heavily regulated. Rest of the world, not so much. Anyone could get in, there's ways to get around everything nowadays. We all know that. But I think the vault is a tokenization, and it's a really cool angle that's really opened up in this whole thing with RWAs. And I do think you're going to start seeing a lot more RWAs and vaults and tokens all go through this new vault, infrastructure. That's my opinion. So, I'm glad that, that I was actually able to hopefully give some more information on something that you didn't know about, considering that's what these vaults were. So I'm assuming now that these were different than the vaults that you've seen in other apps.
It's possible, but I don't know what was underlying them. There was a chain that I had thrown in on for a bit in Singapore that operated through a mock of the stock market, I believe. And then there are various exchanges that do run something that they call vaults, and those have a certain investment amount that you're supposed to receive on those, but you don't know what's underlying on those. It's not exactly open. They don't tell you what strategies are going to be going through, if any, or what's going on there. But they do offer those specifically for things like USDC, Bitcoin, and others, and those aren't exactly stakeable tokens, so they have to be doing something with them.
Yeah, I think a lot of the other things I've seen with the vaults is a lot to do with staking and the yield element. It's a way for you to, let's say, you can put the 3x Bitcoin, let's say, from Toros inside the vault, and then create a leveraged version of Bitcoin inside the vault. So the other things that you can probably, that you can look at it is, a lot of people I've seen, the most popular vaults that I've seen are definitely for access for staking and for yield. So you could use the vaults to pretty much create staking and yield strategies, right? Whereas the angle that I've approached is, the problem with cryptocurrencies, owning it as an asset, is that you're exposed to what we call the fat tail risks, right? The risks of having the 80-90% crashes. Nobody likes that. It's those events that destroy long-term wealth creation. So if you find a way to minimize your exposure to the worst days that you could have with cryptocurrencies, it incredibly shifts your long-term wealth creation. It protects you more on the downside. And one of the best ways of winning is by not losing. So I've used the vaults to have actively managed, trading strategies, as opposed to what most people have is passive, right? You're just buying Bitcoin and then you're holding it forever. Or maybe you're doing a technical analysis trading system. But the point is that, there aren't very many players out there, starting to get a few, that are actively managing Bitcoin. Like people actively manage stocks, you're doing it Bitcoin. So that's one advantage of those vaults. So you could look at vaults as one for staking for yield. So you're going to buy a vault because you can get access to someone's staking and yield strategy. You could get into a vault because you might have access to things that you would not normally have access to. right? You could have wrapped gold. You can buy gold inside a vault, and instead of going and spending all, how much it trades an ounce, or, you could buy the wrapped gold as a token, or you can get actively managed trading strategies. So, that's the main uses that I've seen with the vaults. But yeah, I do think the primary one has definitely been with staking and for yield. Okay. So, yeah, so I think the vaults are actually a really, really powerful avenue for tokenization and just a next generation of how to get actively managed trading strategies for Bitcoin and for crypto inside a token. So I think that's really cool. Anyways, it's one of the reasons why I was working on it. So
I wanted to ask you something, Cordell, right? While we're
yes.
on the topic of tokenization still, right? So with it's regards to like trading equities, right? And the tokenization of equities, right? So in regards to tokenizing equities, right? The crypto market is 24/7. You did say previously on this episode that the stock market is gonna go 24/7 next year in like the second half of 2026. Is that true?
NASDAQ is.
Or only NASDAQ? Okay, so how would this affect now, seeing as how like with the crypto market, you can just with tokenized stock of the in the crypto market, you can trade 24/7, right? Do you think there's gonna necessarily be a big difference from people that trade regarding tokenized assets to people that only trade on NASDAQ on the stock exchange?
So in other words, like, what do I think the consequences are going to be of the?
Yes. Are there going to be any consequences, right? Because this is just a question that just popped in my head and just wanted to know.
Well, I think that's the magic. Like, I think that's really what we don't know yet. But I mean, look, you already have some form of, you already have after hours trading, right? So you already have trading between 4 and 8 p.m. And then I think it's from 4 a.m. until market open. Okay, so you already have after hours trading. Now, volumes are incredibly thin, right? So if we already have limited trading volumes between 4 o'clock, let's say, and 8 o'clock, and then 4 a.m. and 9:30, I don't think you're going to get very many people trading now between 8 o'clock at night and 4:30 in the morning, 4 o'clock in the morning. It's that the volume is very, very low. And especially since the majority of volume is driven by the institutions, like, again, pension funds, I don't see them having trading floors, and I don't see them really trading at midnight. I just don't see it. So will it improve liquidity, efficiency? Yes. I just don't know how many people are actually going to be doing it, because how many people, I don't want to say that most people are long-term buy and hold players, but when you think about the amount of assets held in exchange traded funds, just the SPY or a QQQ, which is the NASDAQ ETF, the majority of assets are not short-term, high-frequency traded assets that require trading between 4 in the morning and 4 in the afternoon and 9:30. They're not after hours. So the high-frequency traders are going to love it. The traders themselves are probably going to love it. But if you have no volume, then the trading strategies don't really work, because trading strategies depend on volume. All right, like you need volume. So you're not going to trade an asset that has no volume, because you can get taken to the cleaners because of the bid-ask spreads and everything like that. So I think a lot of it has yet to be seen, but I think the consequences at first are going to be very minimal. Like I would be shocked to see high volume traded. Could be wrong. Again, we don't know. I also am a little biased because I'm hoping we don't see high volume, because I don't want to have to start retraining every algorithm that I have. And I don't even know how that would affect, for people that do what we do, we don't have historical data. We're not going to have historical trading data between when the market's closed and then all of a sudden we have the market open. How do I test the strategy? How can I back test the strategy when I have no data? And I think that's what really scares me more than anything, other than the fear of the unknown, is that I have no data to work with to test it. And that I don't like. So I think the consequences are going to be limited, but should it do pick up, then I think the consequences could be not severe, but statistically significant. Let's put it like that.
Okay, noted. David, you had anything to say?
Well, not on that, but on what it relates to. Like we were originally thinking about what crypto would affect for investments with real world assets and such. And with markets like that, yeah, you may not have as much liquidity in certain places, but crypto is operating without a lot of liquidity in a lot of places because it is very spread out amongst all the different chains, amongst all the different apps, and that's working just fine. With the stock market with after hours trading, a lot of the price action relies on volume there, which is why it's generally not great to trade after hours, because instead of trading between a couple of pennies, you're now trading between dollars. So with crypto, I don't think that there's much of an issue because the price action for it, well, not the price action, but the price, how the price operates with your purchase acts a little bit differently. And that's kind of by necessity that they have to do that. They didn't because they didn't have to think about. They had to operate with the constraint of what if people aren't going to be on this app all the time, because like what if they're we're trying to pull in people from an app from elsewhere, so we're probably not going to be operating with very much volume, and they have to operate under that constraint to begin with. With this stuff though, I don't see too much of a benefit with within the next few years because it really depends on what strategies you're going to be using. Because with regards to real world assets, like we've got very, very inflated assets. Now, a lot of people didn't realize this over the past 2-3, you can go back as far as you want really, but over the past 2 administrations, let's say that, over the past 2. So like, let's say over the past 5 years, there's been a lot of market manipulation. So a lot from when Trump got in and a lot over Biden. So that way, like this way, I'm not political. Neither of them is on my side, so I'm not on either of their sides. Like I'm basically like the Ents in Lord of the Rings. So with Biden, he tried to hurt Russia with manipulation of oil, which hurt OPEC, and then in order to make the U.S. dollar and our holdings in gold seem a little bit better, like there was a lot of price manipulation there, and same for oil, pushing oil prices down, saying we've got all this oil, we've figured out new ways to pull it out. We have all of this demand destruction that's going on over here, and none of that was true. So you saw them talking about oil, about record oil production. Meanwhile, oil producers were going out of business. They said record demand destruction during times when people were traveling more, and same for natural gas, where people needed more heating because it was a record winter. And they said that it was a mild winter before that, and all of this stuff, like they've lied again and again and again and again and again. And it's not just been through Biden's term, it's been through Trump's as well. And so the prices of these real world assets like oil, like gold, have not been reflecting reality, which is why you've seen such a rise in gold over this year, because the manipulation is starting to unravel. They can't continuously say that the dollar is strong, that gold is weak, and that you can't continuously manipulate the price of gold because anytime you push it down, China buys it up because they're trying to get off the dollar, and gold has been a very good store of value. So we're running out of ways to manipulate the market. Real world assets, like holding things, is generally the best way to accumulate wealth. Not the best way, but like if you want to store your wealth as opposed to grow it, then yes. So like holding gold is a great way to store your wealth, not a great way to grow it. So very, very two different things. So as the manipulation unravels, that starts to show itself. You start to see the gold isn't rising in price; it's just showing how weak the dollar has gotten. So just to specify, now with stuff like that, as real world assets start to assert themselves and the real prices start to display, we're going to see a great shift. And with the economic problems that we're going to be encountering, I expect that to I expect that problem to grow even further, for the discrepancies between these two things to grow even further. Now, with regards to that, you have stocks that are thrown in amongst real world assets, but I see a problem there. So like completely breaking this up between commodities and stocks for real world assets. So like they're two different things. One represents companies, the other represents things. And I keep talking about things as opposed to everything else, because things are what ultimately all of this is about. The reason why you had money back in the Middle Ages, for example, the reason why you had taxes and everything, even though they didn't have the dollar, even when they couldn't tax you on gold, they could still tax you on your food production, because what is wealth? It's things. Once you have things, you have the ability to free up time to do other to make or take other things, because you get like it's all about you have to think about things on the base level. It's not about work, it's about the things, and I will specify that as well. If you dig a hole and then fill up the hole again with dirt you just dug out of it, you didn't create any wealth. If you build a table, you've now created wealth. Things versus just the doing, things versus just the idea, all of that stuff. It's about the things. It's about the base level. So now coming back to the stocks, if you have stocks that are all propped up on tech and all propped up on AI, because you have OpenAI buying, you have NVIDIA buying into OpenAI, you have OpenAI buying into these different startups, you have those startups buying into NVIDIA, and you have this round robin going that will end eventually, and that's all propped up by the government, which is maybe not doing that directly. Maybe it is. So I've not checked those grants, but maybe it's not doing it directly, but it is allowing it because they are fully aware and they're just letting it happen.
Yep. I have heard that the shifting money around, by the way, right?
Yeah.
What you've just described is one of the big risks that a lot of people are ascribing to an AI bubble. So it sounds like you believe in that, though, and that this will come crashing down at some point.
Yeah, and OpenAI is losing billions of dollars a quarter, and they're literally asking for a bailout already because they're offering something for an expensive price, which China offers for free. You can't operate a bakery when the guy across the street is handing out donuts for free. Now, this will work until it doesn't. And so I do see a problem happening. And so when we talk about real world assets and strategies and all these things, I do think that we have to keep in mind what may happen in the future. Now, we've got all these different ways to invest in various things that people are trying to look for, but a lot of people are still looking for stocks. And where do people make the money? Where the crowd, where they can take it from the crowd. So what happens with that, do you think? Because I've got certain strategies that I'd want to run. I'd be considering various places that I could put my money as well. Maybe I can access them. Maybe I can't. It's very, very difficult to do so over here in America for various reasons. But what do you think?
I don't know what to think. Well, no, it's not that I don't know what to think, but what I agree with pretty much all of that. I do, and I think this also comes back down to a little of an argument, of discussion that we've been having of the whole Asia model versus the American model, right? Because what you just described is a symptom of the American model, not just the moving the money around, but how much money OpenAI is spending, right? And now needing a bailout compared to what we've seen with DeepSeek, just that they don't seem to be spending the money that they do. And look, I mean, I think what it comes down to here is the CapEx warranted and is the CapEx sustainable? And I think that's really what it is, right? And it's not, is it just the hyperscalers, or is it just really a mass? Are we seeing the entire economy, every layer of the economy spending on this? And I don't think we are. I think it's really just the hyperscalers, if you just described it, are the ones really driving everything. And it's just moving money around. It's moving money from spot one down to another spot down the chain until it gets back to the first spot again. So, and I think that is the danger. I think it will come to a time when people will, when that will just have to slow down. And what the effect is that's going to be, I think it can be. I think that, is that an AI bubble? Yes. Will that cause economic chaos and recessions? Maybe not, probably not. But I do think that is the big risk. And I do think that people don't realize how much of it is just moving money around and just, There's no actual wealth being created, as you put it. There's no products being created. It's just moving money around. And I've heard that from a number of people in the finance business, right? So like, traditional TradFi guys saying the exact same thing. They just don't believe it. It's just money being moved around. And, I also find it, I don't remember where I read it. And I know we discussed it before, David, that the majority of Canadian US startups nowadays are actually using more DeepSeek than they are OpenAI or Google or Claude, Anthropic, right? I think you agree with that. I think more small American enterprises are actually using Chinese models right now.
Yeah, because it's cheaper. You don't have to pay as much in order to use them. No,
exactly.
Well, maybe you can. Google Gemini's low Flash model is very, very close in price on that, but they're probably subsidizing that. I don't know. Now with I'd have to check. I've got the site adaptive artificial analysis. I use that site to check up on
I
these
think
things.
I was on that before.
Yeah,
I think you sent it to me.
yeah, I'd have to double check on their price analysis there. But yeah, Gemini Flash is very, very close to DeepSeek in price. So at least from the last time I checked it. So people could use that as well. But DeepSeek is right there, and you don't have to pay ChatGPT just because it's the first, just because of the brand name. You could
Agreed.
pay for DeepSeek, get 80 to 90% of the power output, 80 to 90% of the speed that of the return, get a return that's just as good, if not better. A lot of people hate ChatGPT's output recently, and
I've stopped using it entirely, honestly.
Yeah, and you can save some money. So if you're a business, if you're a startup especially, you want to save money because then you can put that money elsewhere. Whether it's to whether you're a large company and it's to yachts, or you're a small one and it's to actually making something to try to move your business forward. Once you save money, you can now do things with it.
I'm looking at the price chart now. DeepSeek v3.2 is like the third cheapest. I don't know what Mimo v2 Flash is. That one I haven't heard of. And then Gemini 3 Flash is at 1.1 US dollars per million tokens, whereas DeepSeek is 0.3. Claude Opus 4.5 is at 10. Now, I love Claude Opus, okay? Like, I've even decided to spend on a Max because of how much I use Opus. And I do, especially for a coder, I think Claude Code is one of the coolest things I've ever seen. So, but yeah, the usage limits on Claude were driving me insane. It almost made the thing unusable. So I figure, you know what, pay for the Max. It's a business expense anyway. It's a legitimate business expense. So you might as well just go for it. So, but yeah, because I just built an agentic AI system. And one of the reasons why I'm just as a side note here, I just built an agentic AI system to just does a lot of the manual curating of my investment universe that I have to do on a monthly basis. So I'm like, well, instead of spending an hour going through additions and deletions to all the indexes, I just created an agent to do it. And then, of course, can't do this on a free tier. So I started comparing all of them, and I wound up going with DeepSeek, also because of how easy it was just to open the account, put $2 into the account, as opposed to having to set everything up on Google Cloud. So while Gemini might be close to price or whatever, it's still harder to set up the whole billing and everything on Google Cloud. And I found it a little deceptive at the same time. Whereas DeepSeek, you just go to the website, create your account, put in $2, you have your API key, you're good to go. I'm like, sold. So yeah, I don't know. It all comes back down to, is this current infrastructure sustainable? And it isn't. I think we'd all agree that it isn't.
Yeah, that was actually something that I argued with the businessman before on. Like, he was trying to figure out what, why is everyone going over to piracy? How do we stop piracy? I was just saying, it's like, well, it's ease of use and price. So make things easy to use and make them cheap. And people will buy that. That's exactly why people went over to Netflix. That's why piracy dropped when Netflix came out. That's why they're going back to it now, because you basically remade cable. You have all of these different companies that are just making things worse, making things harder to access because they block access to this video. They block another one blocks access to this other video, and now you have to have 2 subscriptions in order to watch what you want to watch. Or you can go over to this piracy website, act like
Yeah.
Johnny Depp for a bit, and watch what you want to watch. And he just did not get it. It's like, but what do you mean ease of access? Like, how does that stop the piracy? It's like, I just said how you stop it. Like that. This is what people want. They want it easy to access, so they don't have to think about all these different hurdles to jump through, and they want it cheap so they can afford it. How difficult is that as a concept? But like a lot of business people just literally cannot wrap their minds around it.
Yeah.
So
Yeah. So guys, I
one-
think we've been running a little long today. Eh?
a little bit. So as we come to, the end of the year and the end of the podcast, I just want you guys, opinion, or let's say predictions. This is not by any means financial advice. We're just owners of companies. So I just want you guys predictions for 2026 for crypto. Just like, let's say in a short one-liner.
I think right now, I mean, it's very hard to make a prediction. I would say you got to keep an eye on Bitcoin. If it falls below 83,000, I would say look out. And then this thing's easily going to get down to 70. I think it is constructive. Most of the things that I've seen in terms from an investment point of view, I would think the charts are constructive right now and do warrant, starting to take smaller positions, betting on a short-term rally, or at least a rally happening in the first couple of months of the year. That's what I would say right now. But my main concern is that Bitcoin breaks down below 83,000, and then it's like all bets are off.
Mm-hmm. You, David?
I don't think I could do it in one line.
I didn't. I tried.
Well, just let's short form as possible.
All right. So with a lot of economic factors, for a lot of various reasons that I've mentioned in other videos as well, I think that the US is going to encounter some economic difficulty. I don't think that that's going to benefit tech. And when tech drops, crypto drops. So without a bailout, which I do think is likely to come, whether or not that's going to be successful, I don't know. But if a bailout comes and that props up tech, then you could see a rally. If it doesn't, if people see that as the onset of hyperinflation and try to bail out, try to bail out of the system, then you could see that drop, and that will affect crypto and drop that as well. In recessions, in previous recessions and previous economic difficulties, you've not seen it hold up as a hedge against that. People sell crypto in order to buy things. So I would expect similar, but it really depends on how people react to that upcoming I believe it's coming to the upcoming bailout of the government of these different businesses. The economic easing, what was it called? Quantitative easing. The upcoming quantitative easing that's going to be occurring. I don't think that there's I haven't checked for sentiment, but it really depends on how people are going to take that upcoming action, in my opinion.
Okay. So for me, I think basically the market's gonna go worse. Will get worse before it gets good. So I think from January going all the way to summer, I'm gonna be looking at whatever startups or tokens, cryptocurrency that are gonna be focusing mainly on utility. I think that right there would be, I guess, the bread and butter for next year. But I do think the market will crash again, seeing as how Bitcoin is like 80,000 right now. It's probably going to get worse. As Cordell probably said, it could get worse. But other than that, this has been episode 8 of the Crypto and Coffee podcast. Thank you guys for tuning in yet again, and continue watching. If you guys want to take a bit, talk a little bit more about AI, or listen to us a little bit more about AI, we did do it on, I think, episode 7, right, where we did talk a little bit more about AI itself. So check that one out in our previous episode. So thank you.
Thank you, everyone. Happy New Year.
Yeah, Happy New Year.